What I do want to suggest to gold people who've been in it for a lot of years, who saw it trade basically in a range for a lot of years, don't get caught in this concept of people that have been bearish going, it has to go back because it's so far higher than it used to be. No, that's not the case, especially given the fundamental argument now for gold. I would just say that it would be hard pressed to see gold much below 3,000 anytime within, as far as our eyes can see, but a very strong chance of 4 or 5,000. So you still need to look at gold favorably, in my opinion.
Gold has delivered its strongest performance in over a month, driven by a mix of macroeconomic pressures and renewed investor appetite. With the US dollar weakening and bond yields declining, the environment has turned increasingly favorable for the metal. When the opportunity cost of holding non-yielding assets like gold falls, investors often move in, and this time is no different. Furthermore, geopolitical tensions and ongoing trade disputes, particularly between the US and its key partners, have added a layer of uncertainty that's pushing safe haven demand even higher. PeterGrandich of PeterGrandich and Company remains firmly bullish. He challenges the idea that gold must pull back just because it's already seen substantial gains. In his view, the current fundamentals remain solid, and there's no reason gold can't push even higher, potentially to $4,000 or even $5,000. He also doubts that we'll see gold dip below $3,000 anytime soon. Central banks remain major players in this market. Grandich highlights sustained buying from countries aligned with the BRICS, underscoring how gold remains a trusted store of value during periods of global economic instability. Even the Central Bank of Brazil, which hasn't added to its gold holdings since 2021, reported a 23.4% increase in the value of its reserves in 2025. The rise in gold prices has increased the total value of Brazil's holdings to $13.7 billion. Silver isn't sitting quietly on the sidelines either. It's been gaining traction among investors who see it offering even more upside in percentage terms compared to gold. While Grandich isn't completely shifting his portfolio, he believes silver deserves just as much attention. Prices rose again in Monday's European session, marking the fourth straight day of gains and pushing toward a 14-year high. Strong industrial and investment demand continues to fuel silver's momentum, suggesting it may have more room to run. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It is done. You get a little nervous when it does mostly what you hope and expect it to, especially over a long period of time, because you have to learn to say the words, I was wrong in this business, or else you'll never last. But it reached a peak. It was at a point when it got close to 3,500 that I actually sold physical bullion so I could get more exposure to mining shares and juniors, and the belief that there'd be a consolidation period for gold. I had hoped that it would last the entire summer. And the reason is I felt, one, I'm a big believer in moving averages in commodities, and the moving average of gold where it was versus where the moving average was, the 200-day, was so far that it almost had to stop running, which it did. And now that moving average has crossed over 3,000. And if you want to believe in 4 or 5,000 or more in gold, which I do, the longer this consolidation period would go, the more benefit it would be to reach that. So I'm as pleased as anything. I think the reasons why gold did what it did, it's always easy to look back, are still valid. Central banks are major buyers. Many of those banks are associated with the BRICS movement. The BRICS movement is moving forward no matter what Donald Trump wants to try to say about it. And people are starting to realize that there are a lot of other issues, both domestically as well as worldwide, where gold has become affordable. I would like to make one point, if I may. I've tried to do this in interviews. It's not often discussed because there aren't old dinosaurs like me left still talking. But when I started way back in the dinosaur age of the early 1980s, the U.S. stock market for 13 years traded just between 700 and 1,000. In fact, people were so bearish on stocks that there was a famous Business Week front page story called Equities Are Dead. That they never saw the stock market ever going up much again in their lifetime. And a young man came out of Gainesville, Georgia, that no one knew of, named Robert Prechter Jr. at the time. And he predicted a 3,600 Dow based on something no one knew about called the Elliott wave theory. And I remember my broker, I was a warehouse manager, and I remember him scoffing. He said, who's this kid? What does he know? The Dow never goes over 1,000. Well, we all know I'm not saying gold's going to go to 40,000 too. What I do want to suggest to gold people who've been in it for a lot of years, who saw it trade basically in a range for a lot of years, don't get caught in this concept of people that have been bearish going, it has to go back because it's so far higher than it used to be. No, that's not the case, especially given the fundamental argument now for gold. I would just say that it would be hard pressed to see gold much below 3,000 anytime within, as far as our eyes can see, but a very strong chance of 4 or 5,000. So you still need to look at gold favorably, in my opinion. So the first thing I did was the majors, because they were starting to print money. Their record free cash flow, which is only continuing and getting better, was a reason to think that they would be more leveraged to than what the gold price itself could go up. The important thing there also is to understand is that gold goes up $100. Their costs aren't going up to match that. So the gold producers, the significant gold producers, should continue to see record cash flow and therefore can still be owned here. Where I then switched into, and the nickname I gave myself years ago, and it's appropriate, Riverboat Pete, is the most riskiest, and that's the junior resource stocks. A market that 2-3 years ago, most of us who were still in it, that somehow, whatever reason, somebody closed the door and we weren't watching and we're caught in this horrific zone that we'll never get out of. That market is lifted, but it hasn't taken off yet. And I think that's the next big story in the metals, that the juniors, the little guys and gals, that many times, failure is the norm. Not all of them are going to find mines at all, but the market in itself is going to be lifted. And one of the reasons is because the metals have become so prominent and become mainstream stories. I've heard more people talking about copper who will be considered generalists, not people who, like you and I, that spend a lot of our time in the metals market, who really don't spend any time. But because they heard, hey, it was tariffs were put on it, and then they learned about the story and the supply and demand, are now shopping for ways to play for it. And that will come down to the junior market. So I feel really good, not only for gold and silver and copper and uranium, which I went back into after having the best returns I ever had in my life in the first go around. And in April, got very fortunate to buy them back at the lows again. But we're in a really near perfect storm. Now, somebody will go up, sell. Grandich said it's a near perfect storm, but we really are for copper and uranium, especially. The supply and demand scenario is so powerfully bullish that there's nothing really to be seen other than price appreciation getting too far ahead to really stop it from going up. So I really feel very, very good compared to any other time. I always feel good when you speak to me. I don't sound that way. But in terms about the markets, I feel really, really good. And I feel really good for where I pushed a lot of chips in that we're seeing progress now. And I think it's set to take off as well, meaning the junior market. When it went under 30, I put out a big thing. I put this silver dome on the top of my head and the writing and all. Because I used to say, people used to ask me, Mr. Grandich, what do you think of silver? And I said, well, it's like kissing your sister, So that changed. And I put it on the same level. In fact, about 2 months ago, I wrote that I think it's about to lead gold, that it could actually go up more percentage-wise. So I'm a much better believer in it. I still will not overweight myself in it, but I would have as much silver as I would have gold now. And of course, the silver mining stocks and all. But my favorite for this year was, and still remains, is copper and uranium. And so I would say that uranium and copper are battling it for first place, but right close to them second is gold and silver.
The global financial system is gradually shifting toward a post-dollar reality where dependence on the US dollar is waning and a broader mix of national currencies is emerging to take its place. A multipolar currency model is gaining traction, one that reflects the growing complexity of global trade and finance. While some view this trend of de-dollarization as disruptive, it could ultimately lay the groundwork for a more balanced and resilient global economy. PeterGrandich sees real momentum behind this shift, citing the growing influence of the BRICS bloc. In his view, what once seemed like a fringe narrative is now becoming mainstream. The BRICS narrative has only gotten stronger. More and more countries want in, he says. It's become clear that the geopolitical winds are shifting. Grandich believes that within the next 6 to 12 months, the consequences of the U.S.'s aggressive tariff policies will become more apparent, especially as alternative trade alliances continue to grow and mature. The growing assertiveness of the BRICS bloc hasn't gone unnoticed in Washington. Tensions have escalated, particularly following the July 2025 BRICS summit. Former President Donald Trump responded with a familiar tactic: tariff threats. In a post on Truth Social, he warned that any country aligning itself with the anti-American policies of BRICS will be charged an additional 10% tariff. This kind of rhetoric underscores the widening divide between the United States and a rising coalition of emerging economies that are actively reducing their exposure to the dollar. Let's get back to the interview.
Well, how he sees it and how the rest of the world is seeing it, I think, is two different stories, Charlotte. As you know, you're correct. The main thing that got me into gold in 2021, I made a decision that probably 1 in 50,000 people didn't do. I sold stocks and bonds just to own physical gold, mainly because I believed the price was going to be driven up because all these central banks were going to buy gold, because eventually they have recognized that trading, at least minimally among themselves, or eventually a new world reserve currency will have to come into play, and it will not be able to be a full fiat currency. It's going to have some sort of physical hardness to it, and gold was the best thing that they could see that it was. And that was the theory of owning gold, and it's played out. The BRICS story has only gotten better. I like to say that who's ever the head of new membership director for BRICS has to have a big smile on their face, because people have realized that Trump has taken a big stick into this trade war when he should have took an olive branch. And if you look at what he was saying weeks before and then days after he implemented his program, all of it was basically saying they're going to be at my feet in a matter of days begging for deals. Well, here we are, the middle of July, and there's no real deal of any consequences that's been done. Countries are now openly, including Canada, speaking opposition to it, that we're not folding, or, it has to be fair for us and all. Will he get something different than existed before? Yes. Will it be anything close to what he sold it on and what the stock market currently thinks is going to happen? No. And therefore, I don't think tariffs, while we're talking about them now, we'll be talking about them in the same manner 6 to 12 months from now, because I think what will be recognized by then is Trump's done more to hurt the long-term prospects for the United States than help. That's a minority opinion right now, but I'm kind of used to being the minority opinion in 40-something years. It's been the life of a contrarian that I've mostly been. But I do think if you look outside U.S. media and you look at financial media in Asia or Europe, they will concur with that these countries are moving away from the United States. And after it's all said and done, they will not have the same great, the Magna Group likes to say, make America great again. And they also like to think that somehow it'll be like it was 40 or 50 years ago. That's impossible. It's totally changed. And it sounded great, especially after the last administration, where those type of people couldn't stand for a minute for what they were doing. But I think a lot of things are being chipped away on Trump. And I think he has other issues now with Powell and this Epstein stuff and all, that he's just not going to have the influence that people perceived back in April that he could have regarding tariffs. The Fed beige book come out as you and I speak today. And it's, again, showing an economy that's clearly decelerating, not to the point where it's falling off a cliff, but it's weakening on several fronts. I don't see anything. I mean, Trump can yell all he wants about we got to get interest rates a lot lower. Yeah, that's great. But look what happened by interest rates going to 0 or 1%, all the issues we have now and all. But separate from that is just cutting interest rates is not the reason. But there's a reason he's doing that a lot of people don't talk about. We have $10 trillion almost that has to be refinanced in the United States. If he could get it 1% or 2% lower, it would not be as bad for our debt and deficits as the case. But we have to remember one thing. When the Fed cut interest rates a year or so ago, the long end went up. It increased by 100 basis points. And that's because people are starting to realize, hey, not only is the United States never going to pay back this $37 trillion on our way to $50 trillion, they may start having problems paying our interest. We're going to want a higher interest rate in order to buy your debt. That's the big challenge. I say this often now, especially in our planning group when we talk with people. Folks, you got to watch the bond market, not just the stock market. A, it's much bigger. and it will have more of an influence on your economic and political life than the stock market will. And the bond market is continuing to suggest that the least resistance in rates is up, not down. So they're not rushing here yet. Because still what they focus on is still doing pretty good. The general equity market, whether it should be there or not as well. Cryptocurrencies, which was the biggest negative towards the junior resource market, is doing good. It's lead, it's making new highs. But where you're seeing the interest particularly is on the institutional end. For instance, a few fund managers have said to me, hey, I could have bought all the junior private placements I wanted 2 years ago. Now I can't even get 25% of what I'm asking for. And they're no more best efforts deal. They're bought deals. Generalists, one company that I'm involved with has put on a series of presentations to institutions, and over half the people in the audience, and all of them, were not people who were precious metals money managers. They were just general money managers. So their ears are open. They're not going to go right to the bottom of the peg and stop buying juniors. They're going to start with the majors, but then become accustomed to it, and then doors will open and things of that nature. And that's one of the other main reasons that I feel really, really good about it. And the fact that the argument for the metals itself shows no real downside to them of a significance, and therefore it seems all systems are go.
Precious metals are no longer just a hedge. They're becoming a frontline strategy in a world where traditional financial anchors are shifting. As global power centers reconfigure and currency dynamics evolve, both gold and silver are finding new relevance, not just among investors, but at the highest levels of central banking. The recent spike in gold's valuation and silver's persistent upward climb suggest that something deeper is unfolding, a recalibration of trust in fiat currencies, and a search for assets with intrinsic value and staying power. Could this steady repositioning of global reserves and investment flows be an early sign of a new monetary era? One where physical assets and regional alliances supersede the legacy dominance of a single currency? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.